Variance analysis is a key component of standard costing systems, enabling management to compare actual performance with predetermined standards and identify deviations requiring investigation. While material, labor, and variable overhead variances focus on variable production costs, fixed overhead variances evaluate the effectiveness of planning and capacity utilization associated with fixed manufacturing resources. Since fixed production overheads remain relatively constant within the relevant range of activity, their analysis provides valuable insights into budgeting accuracy, production efficiency, and capacity management. Effective interpretation of variances allows management accountants to identify operational problems, assess managerial performance, and recommend corrective actions that improve organizational efficiency and profitability. Fixed overhead variances. The fixed overhead total variance measures the overall difference between the fixed production overhead absorbed into production and the actual fixed overhead incurred during the accounting period. A favorable variance indicates that absorbed overhead exceeds actual expenditure, while an adverse variance indicates underabsorption of fixed overheads. The total fixed overhead variance is commonly divided into two principal components: expenditure variance and volume variance. Fixed overhead expenditure variance. The fixed overhead expenditure variance compares actual fixed overhead expenditure with budgeted fixed overhead expenditure. This variance evaluates management's ability to control fixed costs such as factory rent, depreciation, insurance, supervisory salaries, and maintenance contracts. A favorable expenditure variance arises when actual expenditure is lower than budgeted because of effective cost control, negotiated savings, or reduced administrative costs. An adverse variance may result from inflation, unexpected repairs, salary increases, or poor expenditure control. Unlike variable cost variances, expenditure variance is independent of production volume because fixed overheads remain relatively constant over the relevant range. Fixed overhead volume variance. The fixed overhead volume variance measures the effect of producing more or fewer units than originally budgeted. If actual production exceeds budgeted output, fixed overheads are spread across more units, generating a favorable volume variance. Conversely, lower production volumes produce adverse volume variances because fixed costs are absorbed by fewer units. The volume variance itself may be subdivided into capacity variance and efficiency variance, providing more detailed operational analysis. Capacity variance. The capacity variance measures whether actual working hours differ from budgeted hours. A favorable capacity variance indicates that available production resources were utilized for longer than planned, reflecting improved utilization of factory capacity. An adverse variance may indicate idle time, machine breakdowns, labor shortages, or reduced production demand. Capacity variance, therefore, evaluates the extent to which production facilities have been utilized during the accounting period. Efficiency variance. The fixed overhead efficiency variance measures the efficiency with which production resources were used. This variance mirrors the labor efficiency variance because fixed overhead absorption frequently depends on labor or machine hours. A favorable efficiency variance indicates that production required fewer hours than expected, reflecting improved productivity or operational efficiency. An adverse variance suggests excessive labor hours arising from machine downtime, poor supervision, inadequate training, or inefficient production methods. Together, the capacity and efficiency variances explain the overall fixed overhead volume variance and provide valuable insights into production performance. Interpretation of variances. Variance analysis extends beyond numerical calculation to include managerial interpretation. A favorable variance is not always desirable, nor is an adverse variance necessarily evidence of poor performance. For example, a favorable material price variance achieved by purchasing inferior materials may subsequently generate adverse labor efficiency and material usage variances due to production difficulties and increased waste. Similarly, favorable labor rate variances achieved by employing less skilled workers may reduce productivity and increase quality defects. Consequently, management accountants should interpret variances collectively rather than in isolation, considering operational context and underlying business conditions before drawing conclusions. Investigation of variances and corrective action. Not every variance justifies investigation. Management commonly applies the principle of management by exception, focusing attention on significant variances likely to influence organizational performance. Before investigating variances, management should consider the monetary significance of the variance, the percentage deviation from budget, whether the variance is recurring or exceptional, the cost of investigation relative to expected benefits, whether the variance is controllable by management, external economic or market influences. Possible causes of material variances include supplier price changes, poor quality materials, wastage, theft, or inefficient production methods. Labor variances may result from wage negotiations, overtime premiums, inadequate training, absenteeism, machine downtime, or changes in labor skill levels. Overhead variances may arise from inflation, energy price changes, maintenance expenditure, underutilization of capacity, or budgeting inaccuracies. Appropriate control actions may include supplier renegotiation, improved inventory management, employee training, revised production scheduling, preventive maintenance, budget revision, process improvement, or investment in new technology. Interrelationships between variances. Variances rarely occur independently because operational factors often influence multiple aspects of production simultaneously. For example, purchasing cheaper raw materials may generate a favorable material price variance, but adverse material usage variance because of increased wastage. Adverse labor efficiency variance because inferior materials require additional processing, and adverse overhead efficiency variance because production takes longer. Similarly, labor shortages may create adverse labor rate variances through overtime payments, while simultaneously generating favorable labor efficiency variances if experienced employees produce output more rapidly. Understanding these interrelationships enables management to identify root causes rather than treating individual variances separately. Determining unknown actual or standard figures. Variance formulas may also be rearranged algebraically to calculate missing standard or actual values when variance information is provided. If 3 variables are known, the 4th can be calculated directly. Similar rearrangements apply to labor, sales, and overhead variance formulas, enabling management accountants to reconstruct missing production data and verify operational performance. Overall, fixed overhead variance analysis and comprehensive variance interpretation provide essential management information for evaluating operational efficiency, identifying performance problems, strengthening cost control, and supporting continuous organizational improvement through evidence-based managerial decision-making.